The liability-driven investing, or LDI for short, has been described as the balancing act between the investment of a fund's assets on the one hand and its constantly changing liabilities on the other. Previously the domain of large pension funds, the approach has merits in being applied to the needs of defined contribution funds, as well as being used as a tool in individuals' financial planning portfolios. Dwayne Kloppers from Alexander Forbes joins us in studio to tell us more. I think we've got to break that down a little more. The liability-driven investing, as we said, the domain of the big pension funds previously. Perhaps just for the layperson, in your own words.
Yeah, yet another acronym for us all to remember. Liability-driven investment, really, it's a specialized portfolio management technique focusing on meeting your financial objectives. So let's unpack that a little bit from the perspective of what is it not. More conventional asset management really focusing on maximizing return or perhaps reducing volatility. This new vehicle or new technology focuses on meeting your financial objectives, your liabilities. If we look at traditional uses, life offices, they issue annuities and they make a promise to their clients in the future. Meeting that promise requires earning a certain investment return, and that is really the domain of LDI, focusing on meeting that return and minimizing the risk of not meeting that return.
So Dwayne, just in particular with reference to an individual's portfolio, I know you guys are doing a lot of work or expecting to do a lot of work with defined contribution funds, but for the lay investor, what sort of liabilities are we talking about when we consider this balancing act between the investment returns and a liability in the future?
Typically, investors fall into one or two categories, I think, in the retail market, either just using their discretionary assets, not saving for something specific, perhaps trying to maximize returns. LDI really focuses on specific objectives. So if you want to send your child to university or if you want to save for retirement, that sort of thing. Now, currently in the defined contribution environment, there hasn't really been much of an uptake of liability-driven investments, and we really think that's because of the technical complexity thus far. I think in South Africa, the first applications were seen in investment banks, life offices, and that's trickled down into the large, more sophisticated defined benefit funds, and we're really hoping that the next step is defined contribution. I don't think the individual is necessarily in the near future going to be using it directly, but I think the first place we'll see it moving into the defined contribution space is in investment vehicles, portfolio strategies. A number of the big houses offer life staging solutions which really talk to the risks of retirement savings. Within those solutions, there's typically a growth strategy early on. We're not talking about changing that. Most members really need that equity return to earn an adequate return to be able to retire comfortably. What we're talking about is during that whole savings period, there are allocations to low risk assets, and specifically as you approach retirement, those low risk assets start to increase to de-risk you, and we're talking about focusing that de-risking on your liabilities rather than on just a volatility.
Is this going to solve the problem that we're facing right now in the pension environment across the board, across the globe? And that is that people are living longer. Apparently the first person that is going to live to 140 is currently 40 years old. So I think that puts things into perspective. And of course, it's a big battle that pension funds are dealing with right now, is people are just going through all the evaluations, all the actuarial models. So does LDI address that?
It's definitely going to help. Let me give you an example. I think across the last 10 years, many people will have noticed that the cost of retirement has been escalating, and that's due to a number of factors. One of them you mentioned is longevity, but one of the other big factors is yields coming down. So really the rate of return that's available and the kind of returns engine that's behind all of these annuities that people buy.
You mean we're in a low yield world for longer? Get used to it.
Correct. Within that low yield environment, how do you earn enough returns? In particular, across the last 10 years, there's been this escalation in the cost of retiring. Across the last 5 years, you're probably looking at between 5 and 10% escalation in the cost of buying really the same retirement income. And liability-driven investment could have protected investors against that element of that appreciation in cost. It doesn't address something like longevity, but it does go some way to addressing some of those risks, really just aligning your investments more closely to your needs.
So Dwayne, just to get this right, so when we're talking about this liability that investors purchase, and well, effectively what you're talking about is the annuity that investors purchase when they get to into their golden years, so to speak. So when you get to the age of 65 or whatever age you choose to retire, you need to have enough money that you can buy an income stream with that money that will allow you to enjoy the same level of lifestyle that you had pre-retirement. Is that what we're talking
Correct.
about on the liability?
That's probably the biggest application within the defined contribution space, or potential application. There are other investors with fixed liabilities who use this technology. A big use is within the mining rehabilitation area, large liabilities being funded. One obviously wants to minimize the cost of that. Also, obviously, life offices and defined benefit pension funds.
Dwayne, just to follow in there, just with another question, and we kind of have this amazing, almost bipolar South Africa, where we've got an equity market that's delivered the best returns over 100 years above any other exchange in the world, and at the same time we've only got 7 to 8%, according to different people, retiring with enough money to enjoy the same sort of lifestyle pre-retirement as post-retirement. If we leave the LDI, what are we doing wrong if we leave the LDI out of it at this point?
We're doing a number of things wrong. I think probably the biggest problem is conserving your assets. So a number of people, when they leave their employer, they'll draw those assets out, use them to do whatever, fund their lifestyle for a few months. That's really one of the things that social reform also looks at addressing. How do we encourage people to conserve those assets better? And really adequate savings. I don't think we necessarily have an adequate savings culture within South Africa, or fully grasp how much it costs to save for retirement. I think the typical contribution rates you see within a defined contribution fund are much lower than what you see going into a defined benefit fund. And I think many defined contribution members are not necessarily exposed to those sort of figures and don't necessarily realize just how costly retirement is. And really encouraging a savings culture, I think, is important.
Just to perhaps debate this a little bit further, we've had this massive shift from defined benefit to defined contribution in this country. Overseas, it's a little bit different. It's still a very big defined benefit market. In a defined benefit fund, the way I understand it is we have clever guys like yourselves, actuaries, that have to make sure that these liabilities are met in the future. Whereas in the defined contribution funds, we have trustees that are in charge, but perhaps lack the sophistication and the tools that you find in a defined benefit fund. Do you think that's got some of the reason to do with this massive drop-off in the amount of people that are saving adequately for their retirement years?
I think definitely. I think the concept of funding your retirement, it's quite a complex problem to solve. It's not trivial. You can't immediately see what the solution is in terms of what to invest in, how much to contribute. And I think that's one of the hidden issues with defined contribution funds, is that not only have you shifted investment risk to the individual member, you've also shifted quite a bit of the problem solving, or the difficulty of understanding how to get to retirement adequately. And that is a feature of defined contribution. You mentioned overseas that there's still a bigger portion of defined benefits. Within the last sort of year, the UK now predominantly, or the bulk of retirement assets in defined contribution funds rather than defined benefit funds. So you really do have that shift happening globally. Although South Africa has been a leader in that area, it is something that's happening globally, just as employers aren't really willing to hold those financial risks anymore on their balance sheets. Just
a two-folded question here. Obviously, defined benefit very big overseas. I wanted to ask just your opinion in terms of how many funds are meeting their liabilities at this point. And the second question, and I think it's one, Bronwyn, we've discussed quite a lot on the show with fund managers, we talk about unintended consequences. And quantitative easing is creating an unintended consequence in the shape of liabilities. They're making the liabilities for pension funds bigger. So I just wanted to get your view on those two things. What is the sort of the amount of funds that are meeting their obligations? And then we can talk about the survey that you guys have done, and also some of these unintended consequences you're seeing in the retirement market.
Interestingly, overseas, probably the majority of funds being underfunded in the defined benefit context. Locally, I think probably the majority are sufficiently funded. A number of reasons for that, potentially more prudent management or more conservative management, but also just the massive bull runs that we've enjoyed in our equity market. So probably a stronger funding position in the defined benefit funds. I think our biggest problem in terms of underfunding, and I say that in inverted commas, is the defined contribution market. A number of members just sitting on insufficient assets. Because you don't have explicit funding level reporting or a balance sheet in terms of their retirement funds, you don't necessarily notice that as easily on the defined benefit funds. The second point you mentioned about quantitative easing is very interesting, and it sparked enormous debate in the UK. Has quantitative easing impacted pension funds and members retiring to pensions or retirement? Absolutely. It definitely has had an effect. What is the major effect is really, as these assets have moved into the markets, there's been price inflation, and that price inflation has driven down the yields that are available, in short, making annuitization more expensive. So really the cost of buying yourself a retirement income has increased during this period, and that results in a bit of a redistribution of wealth. There have been studies overseas in the UK looking at this. Really, the equity markets also ran during those periods due to liquidity making its way into there. So the conclusions are generally that in the UK, on average, people were roughly equal, because you had the equities kicking upwards and the cost of retirement going downwards. But that's really on average. There were members who were prejudiced by it. There were members who benefited from it. One of the big phenomena is probably members who had a large equity exposure. There was this asset inflation, and they benefited from it.
Okay. Just in terms of, you guys have recently launched the first LDI survey. Tell us a little bit about that. Who are you surveying? What are the objectives, and how's South Africa doing?
So I mentioned earlier that LDI is technically complex, and that's really been a limiting force in terms of its take-up. That's something we wanted to address. Alexander Forbes is a big drive at the moment to improve the industry. We're a large player. We really want a stronger, better industry to operate in. And one of the free initiatives that we've done is this LDI survey. The survey is a performance survey and a risk survey, so it really looks at the various LDI managers in the industry, and it looks at how effective are they at hedging your liabilities and how effective are they at outperforming these liabilities. And what we found, we've been running it on a public basis for this will be the second month now. We found that most of these managers are able to outperform their costs, so to give you your liability performance and cover their costs, and still track liabilities incredibly closely. So that's a great message for people saving towards retirement. You have this really new vehicle for low risk investment, low risk relative to your liabilities.